Alrighty, what's happening? Jason here, SmartHelping.com. We're continuing on this automated robotic kiosk financial model. We've still got a lot of updates because yesterday we did a whole bunch of stuff with the revenue logic. Before I get into everything, let's send out the old tweet. Let me get the link in here. Sound and audio looks good. Live financial modeling now. Excuse me. Okay, and don't forget, the model we're upgrading is part of the industry-specific template category on SmartHelping.com. The template is going to be right here, automated kiosk, and I'll get this fully updated. The price will not change. And keep in mind, you can check out more templates here. Check out all financial models on this tab. The categories are here. I've got a color code key for different tiers, and you can buy in bulk by tier. And you can buy all the templates I've ever made here. There's well over 100, it's probably 130, all unique, all valuable in their own way. Alrighty, so let's get into it today because it's a big day. Big day here. Big modeling day. So yesterday you can see all of this was done for defining how revenue happens based on scaling out expansions of these automated kiosks. And we built it based on, the kiosk can have three different products, or you could do categories of products and just do an average price of each item in the category. And we did a capacity-driven model where you have you have a maximum potential that a given kiosk can sell per day, and then which is going to be based on supply constraints and just whatever the machine can do. And so you would know that based on your own data. You put that in here, then you figure out your starting capacities for each type, and you can adjust this by tranche of expansion slot, up to 5 different expansion dates. Determine what the starting capacity is, so this is the percentage of this max you reach, and then the monthly increase in that capacity, and then the stabilized capacity in the long term. So really cool logic there. I did a matrix that did all the math here, and we brought it right over to the monthly detail tab. So we've updated up to here. And we have revenue per product type, which is going to be an aggregate of the activity of all units added cumulatively. We've got cost of goods sold, which is just a fixed percentage of the total revenue. Cost of goods sold defined here. So you can see we put 20%, it's 80% margins. And now what I want to get to is we've got some expense logic to update. And then we'll get into getting the annual detail fixed and just keep grinding. Then we'll get into the income statement and just we'll try and get as far as we can on this thing today. So expenses, running costs. Let's see. I did a couple new pieces of logic here. The first big one was the resupply labor costs. I did it based on the resupply labor count required per one kiosk. So for example, if we put 0.05 here, it means a single laborer can handle 20 kiosks. Based on the count that exists over time, this will populate that, and then the monthly cost that you have to pay them. And this is probably, I don't know, it'll be different for every situation, but that's why you can adjust these numbers. Like if it were 0.5, then each one can only handle 2 a month, or if it were 0.01, they could handle 100. We're just going 0.05 here, but it'll be dependent on every different situation. So we'll have to have, I'm just going to clear all this out because there's fixed and variable. So I'm going to do variable expenses first. And we're going to have some more slots here. And I'm just going to, honestly, we're deleting this entire annual tab because it's going to be easier to just duplicate the monthly and redo it that way. All right, so variable costs, we have, let's list them all out. We have, well, we're just going to call this labor, resupply labor. We also have these two. So this is the monthly cost, and each year you can adjust it maybe if you want it to go up or down or whatever reason. This is the cost per unit for electricity and repairs, and you could lump other things in there and just make it a aggregate. So this we can actually reference here, and that'll be a pretty easy calculation. You can adjust things in blue text only. Circular reference, yeah, I know there are reference error because we deleted annual. I'm pretty sure, yeah, the executive summary was pulling from that, so we'll have to update that, which is fine. All right, let's do the resupply labor first. So what that is going to mean is we do the total units that exist based on our expansion schedule times this variable. So in theory, and it's okay to have decimals in models because it's just an estimate. So this shows you the count of laborers needed. So at 25 units, you need 1.3. At 50, you need 2.5, and that means each one can handle roughly 20. So we got our count there, but we multiply that by the monthly cost, which is input here. And there's our labor cost, completely dynamic with a nice, nice bottom-up feature. So there's our dynamic resupply labor costs. Now, if I were to say, what if I increase this from 0.05 to 0.1? I now need twice as many people to handle the same amount of work, so now my costs double for that. All right, average repair and maintenance, this is easy calc. We do total unit count times, we did a lookup here. So we got to reference the year. We use index formula, it's the least likely one to break if people mess around with the formatting. So we'll index this, and we want to match, I think, E2 or something. I'll look it up in a sec. With this, comma 0. No, it's E1. Okay, and this needs to be 1, 2, 3. This needs to be a general. This actually is not relevant anymore. This is a ratio. Okay, now it should work. There we go. So there's the cost, and then we'll multiply that by the total existing units. And we could do the same thing if we lock these and just drag it down to 10. We get the electricity, which is $750 a month per unit. Now note, these are just arbitrary. Again, you'll put in your own numbers based on your own market research. Let's put these in. Oh, got an error. What happened? I thought I locked that. E9. E1 I gotta lock too. Missed it. Okay, there we go. So there's our variable costs. Now let's do fixed. And for fixed, we just have a month start and then amount per month. And we just did 5 slots for operations. So here we just reference these. 1, 2, 3, 4, 5. Same formula as up here, except Now it is just the index formula only, and we'll start in 13. And that can run down. And note we want to say a couple things here. One, if this date is greater than, or sorry, if this date is less than the start month 0, otherwise do that. Then we also want to check if E4 is greater than the end month. New logic here for the global control. Then 0. Lock that, lock that, and that. That can go down. This is good. Okay. So that's dynamic. You can see these start staggered based on those start months, and then it should end if we ever go past the end month assigned. So if we're to end in October, for example, for whatever reason, you see the stops in October. Now we got to put that logic in for these two. So let's get this in. We just put it at the front here. And drag it over. Perfect. Cost of goods sold will stop automatically when these stop. Perfect. And we might as well put a stop here as well. Oh, shoot. I gotta add the previous. Perfect. Okay. We need to, okay, so we don't want to add, oh, that's fine. It's just the count. Nothing runs off of that after this anyway. So these all stop. That's good. We're now at EBITDA. All this is accounted for. Startup costs we got to add. That schedule should be fine. All this stuff we'll add after we mess with the financial statements. So we got EBITDA, cash flow, debt service, startup costs. All right, let's expand this a little. What are we going down to on that one? 20. Alrighty. And this will just be a sum of all of this, and we just simply directly reference it. All right, debt service is fine. Now we do need to put, let's see, so if this was to be no, we've got to update this to stop. So let's do our stopper formula for the principal and interest. Perfect. Financing cash in. So if E4 equals C15. No, okay, so that's a new, we got to update that. Simply go if this equals debt schedule here, then pull the amount, otherwise 0. A lot of rebuilding in this template because of all the upgrades, but it's fine. It's becoming much better, and that's all we're trying to do is just improve everything we can. Make it dynamic as possible. So cash flow, let's redo this. So we got EBITDA minus expansion minus total debt service plus this minus this. And there's going to be more stuff we add after I get to the income statement, balance sheet, cash flow statement. And we're not doing leverage, non-leverage, just all, you can derive if you want financing or not in the global control. So it's just cash flow here. And then we'll do annual detail real quick by making a copy of this. We go 1, 2, 3 years. Clear. Format these to years. Let's say we don't need this or this. Change this to eDate 12 instead of 1. Update. All right, so we got years. Now units added is now just, everything is essentially going to be run off the monthly. So sum ifs 7 if the year matches. So if 1 matches 1. Now we have to lock this and E1. Okay, and then we just copy paste. And we can run this thing all the way down. Well, why is this 0? Hold on. Hold on. What's going on here? That's not right. These should not be the same. Oh, wait. What are our margins? Let's say this is 5. Okay, now, well, the other thing is, why is this showing blank? It's the currency. Ah. Wait. Okay, I've never seen this before in my life, and I've done these, like, sum if stuff on the annual forever. I don't know why we have an error here. 24. confusing. Oh, hold on. Is somehow this formatted as white? No. Let's clear all. Yeah, something's going on with Excel. Because that definitely is not right. Let's try and copy and paste this over. Oh, now it's working. It's so weird. Wait, what? It's so weird. Okay, well, I mean, so what we can do, I don't know, this is just bizarre. What I can do is just paste. This is a percentage, so this actually works as the same number. So it's just a percentage total revenue, so we don't need to sum ifs there necessarily, because it will be correct based on whatever is as long as the revenue is correct, that'll be correct. So that's 3139 total here, 3139, perfect. Okay, gross profit. My formatting's off here. Let's update this. Cost of goods sold, no shade, then that's dark. And that's dark. Okay. Variable expenses. So here, let's see if this works. I'm so confused on how we had that blank, those blanks show up there. Okay, that seemed to work fine. Let's bold this. This is now total monthly expenses, fixed and variable. All right, EBITDA, cash flow. What is up with this? I've never seen anything like it. If it's a zero, it's actually blanking it out. Like here, what's this format? No fill. Something with this formatting. Yeah, see why are the grid lines getting blanked out here? Uh, I don't know. This is just bizarre. All right, let's remove grid lines. I guess it'll just be blank for the blank. I mean, it's not a huge issue, but the numbers are still right, which is all that really matters. All right, principal and interest. Let's put this back to yes, and this back to the end month. Okay, financing cash in, so this is going to be equal to this. And then if it's later, it could be here. And 0 or blank. Now, the question is, do we match? So 17 million at the end, 17, perfect. So that means all things are lined up. Now that that's done, we can fix this. So annual summary. Revenue is this. Also, this should be bold. How do we lose our month over or year over year change here? What the heck? I don't know how that got removed. Let's put this back. Oh. So month over month would be simply our revenue minus previous month revenue divided by previous month. And if you start later, potentially need if error in here. This is all going to be based on the expansion of units over time, as well as the growth in capacity attained based on the maximum. Now, what the heck? I highlighted here. Okay. And then the year over year. Okay, that's working good. Lots of cleanup here. It feels good though. It feels satisfying to clean these up. So we got revenue, cost of goods sold, gross profit, fixed. No, these are not just expenses. EBITDA, debt service coverage, expansion costs would be this. Debt service is here. Let's put a right border. Now note the we can put in, we're going to put in taxes later. So this is just going to be cash flow. Revenue per product type. So this is a nice breakdown. You could go type 1, 2, and 3 and plug that in. This just equals that. Oh, we need to format it. Okay. Now average revenue per unit. So revenue and then average cash flow. This I actually would much rather put this as EBITDA per unit. That's a much better metric for that. Alrighty, and then break even. So break even revenue. What in the world did I do here? Okay, so what we're gonna have to do is, I know what I did. So we need to give a percentage for variable costs divided by the total revenue. So in this case, this is our variable cost percentage. We'll put that in the monthly as well, 45. And hold on a second. So if I put this to February, do we have errors? Okay, yep. So we'll do if error 0. And we can copy and paste that over to the annual. So that's saying roughly, as you make more revenue, you're always going to have this percentage as variable costs. And that's based on these, which will, the percentages here will do scale exactly with revenue. The percentages here might not, because it's based on what's going on here. So all we can really do is say, well, here's what the rate is at this. It's going to be close to that. It might not be perfect, but it's the best that we can do as far as calculating a break-even revenue. So what we'll do is take that total variable cost against these fixed costs, and then we can define how much revenue we have to make to break even. Which is a nice metric. So here we go annual. Let's adjust these labels while we're here. No need to define monthly or annual, just total expenses. Okay. So now this formula for break-even is kind of tricky. So we need the fixed cost, which is going to be this. So for just this, it could say, well, I need this much revenue to break even. However, we have all those variable costs. So let's see, do we divide by 1 minus the percentage, I think, possibly? So let's see, does that make sense if I make 14,000 minus these fixed costs? And then also, what's my revenue? So if this were my revenue and my variable costs were that percentage here. Okay, nope, that's not it. Let's see. This is always a tricky one. So I want to take that total. I don't think it's not just divided by that. Here I'll see, because the result here should be 0. So if I do revenue, that, So if that's my revenue minus fixed, then I do that times a variable. I get here. Wait, is this working? Yeah, that worked. That worked. That worked. So break even, and then we could do that each time, I believe. Let's adjust the formula for all these. Yep. So this is saying if I make let's format this. If I made 75,000 in revenue, 63,000 is after fixed expenses. Nope, this isn't right either. What the heck did I do here? Revenue, cost after revenue, and then this minus this. I knew it wasn't right. Needs to be equal to 0, so we are not done here. I know it's something with the fixed costs, and then something with that percentage. I swear it was just 1 minus the percentage, which would be saying, oh wait, hold on, that did work. What the heck? Okay, that worked. So if I made 14,000, let's just list these fixed costs. This is getting confusing. Here's my fixed. So this is the break-even revenue. There's my fixed cost. Here's my variable costs. Here's total revenue minus this, minus 0. Okay. So break-even revenue is, 14, 20, 20,800. And that would cover, in theory, all of the fixed expenses and variable, although because we're saying here variable costs are a bit lower. And that's because these don't scale directly. So these cost of goods sold are directly at a percentage of revenue. These are variable, but they're not derived from a percentage. They're just based on the metrics, like the ratio of units added to the labor supply and the cost per unit. So these are going to get smaller and smaller as revenue goes up. But we do need to account for them somehow. So that's basically why you see a less and a less impact of this last number here, and it's mostly just fixed expenses. Alrighty. So that's done. So break even per quarter, per month, per day. You have to make that at least per day to break even in these scenarios. Okay. Let's fix some of this. So 3-year ROI. What are we doing up here? Ending debt balance. That's 0, but let's see if we don't pay it off. Just make sure this works. 211. Okay, good. So that works. Ending cash position will be right here. Net ending value added. So that's an interesting calc. I haven't done that. Min monthly 82. So there's equity requirement to do all of this. Net ending value is saying, oh, so that's just saying how much you need in cash. against the total cash position less any debt. And that's saying how much value was added monthly and annual. Honestly, these calculations are kind of confusing. I don't mind ending cash position and ending debt balance. And you see if we put this back to yes, the ending cash balance would go to 0. Or, I mean, it would go a little bit lower, but then this goes to 0. These calculations, I don't feel are relevant whatsoever. 3-year ROI. We're going to calculate ROI elsewhere. We can do an IRR calculation, though. We can just do IRR of this. Active months. Let's see, is that right? Month if 9 is greater than 0. Nope, we'd have to do, honestly, active months. Let's see. We could just do, whoop, dated if, end month. I don't remember if it's end or start month. This, that, comma, I can't even remember if that's it. Dated if, or is it beginning and end? Okay, and then plus 1. So they'll give you your active months, break even month, 87. This is actually a good calculation. We're going to keep this. So where is it? 87. So whenever we break even, it would be if and our running cash position here was less than 0, but this was greater than 0. The 1, otherwise 0. And it should do right here. And we can just reference, instead of 1, we can just reference the month number. For that dynamic calculation. Alright, so this is all back to normal. Running cash position, let's see. So that is going to be here now. I think we've almost finished unbreaking everything and updating all the logic, so that's awesome. Cash position, that's a good one. I like that chart actually a lot. Okay, this looks good. One thing I did want to add was an ancillary calculation down here. I want to add units sold per month by each type. And to calculate that, we have all these calculations. Remember, we have them here in the matrix. So this is the age, units sold, total for 1, total 2, and 3. And this will give you, this is actually a nice kind of assumption sanity check. Average sales per day per kiosk. Yeah, this is actually really good to do because you can see what's actually even reasonable. So here's the total sales per month. We divide that by the total Do we have the total kiosk count? By type? Let's see. This is actually a really good calculation to make the model really smart for when you're trying to figure out if what you put in makes sense. Because it's one thing to have this logic nice and neat to enter and it works, but it's another thing to actually see what you've actually said about the business by saying these assumptions here. And one thing we want to see as well, what are the average sales per given kiosk based on all of this? So we have the amount per type, and we have, let's see, what's the best way to do this? So on a monthly basis, we know we're selling this many units of type 1, this many type 2, this many type 3. And we know there's 10 kiosks in for example, in this month. So out of 10 kiosks, you're selling 700 of type 1, this, and this. So average sales per day would be an aggregate figure. And we can say, okay, total units sold per day, which is not, it's meaningful, but not, it's a good metric to know, but it's not as meaningful as figuring out the average sold per day per machine. And this is per month, so we're gonna have to do some division. This is per month, and then we'll do per day down here, and just simply go if error, take this value divided by, and then we have working days per month as an input, so we'll divide that by this. So there's the average per day, and then you divide that by the average sales per day per kiosk, which is this number divided by the total kiosks that you have in existence. And there you have it. So in theory, we end up selling 100 units per day per kiosk. When we get to closer to the max capacity, we start out at 16 here. And let's say we didn't change the improvement at all. The only thing that would increase volume would be adding more. And then it would just be whatever this initial capacity attained is what it is forever. The amount per day should now not change. Much. 20, okay, yeah. And then when we get fully scaled out, 20.9. So it does change a little bit here when we add more units to go up to 15. Because what we're doing is changing the percentage capacity up. So if I were to put all these at 10%, I'm pretty sure that would result in no change on the, yeah, so it's just 16 per day per kiosk the whole time. Which makes sense. That's a good test to make sure this assumption makes sense. So we got units sold per day or per month, per day, and then per kiosk per day. And that lets you know if what you're doing is if it's making sense. And then if we put the improvement to 1% per month, what that means is each kiosk is going to do average of 1% better per month in their sales per day. So you can see that logic happening here. Now that is a really nice calculation. And I'd rather, honestly, the break-even's good. Where was that even existing at? Expense summary. What the heck happened to this? That was on the annual. So we can go over here and say, I mean, if we really, this is just, come on. Why can't I remove all these? Okay, there. Remove this, and then is it possible to show this? We don't need fixed in here. We don't need, and then this could be label range. I just don't want to have to put in every single row. Well, it's showing 4, 4, 4, 315. What is it even showing? Oh, it's showing this. I don't know why it can't just do this frickin' thing like it needs to. Alright, I'll just put it down here. So, I mean, all I have to do is put the date, so it's right next to the date and it works. It just Excel's a little weird with this stuff. We can do all the variable costs. Actually, let's just do total variable costs, or total cost of goods sold. Uh, ingredient, material, variable costs, labor, other variable costs, fixed costs. That's good. For year. Okay, and then so for these, it's just this. For this one, we're gonna go all of these. And this, we go here. Now, you can see I can easily remove all this and just go, I want to do this whole area, these amounts, perfect. There it is. Total expense summary. So each year, and there's fixed, labor and other, ingredient other. Let's see, 1.7 million. Does that make sense here? Yep. 1 is 664. Okay. This is fine. This is all fine. Gross profit and EBITDA margin. So we gotta fix this. So gross profit margin is that. These are years. Okay. And EBITDA margin, we can add. Do I have it on the annual? Perfect. So that's just basically showing what your variable and fixed expenses look like against revenue. Okay, good. Average annual revenue and cash flow. Annual revenue and EBITDA per unit now. So in year one, you're making $20,000 per unit in EBITDA. Let's make sure that calc adds up. 20,000 is just, yep, total EBITDA on average divided by units. And the numbers are average. It might be different if you add 5 units every month, rather, or if you add 60 right up front, the number is going to be different, or the revenue or EBITDA against that total unit count. But that's okay. Cost of goods sold summary. I'm assuming, oh please, let me remove this. Okay, so I have to do this. Okay, so new data, and then let's remove all of that. Excel is just odd with this charting. All I'm doing is taking these numbers. And then I wish I could do, and then can I label this? See, this only shows 1 year when I do it like that. Here's each year, 1, 2, wait. I'm gonna have to do the same thing. All right. So we have our cost of goods sold. We have our date here and the amounts. And let's do that chart area. There we go. Okay, so 2021, there's the cost of yogurt. In 2022, 3 and 4, cost of fruit. And then we don't have anything for the other ones. Okay, that's fine, that works. Total unit count, that's fine. Okay, I think we've got all this unbroken, thank goodness. Executive summary looks good. Now, we can finally move on. Let's go income statement. So we have total, well, this is just, do we want to do I guess we could do type 1, type 2, and type 3 revenue. That's fine. That's fine. So it would be these. All right. Cost of goods sold. Very simple. This one. See, all the hard work's now done. These financial statements just need to be updated with the data. Operating expenses. So here we're going to go fixed, variable, and that's it. So fixed would be this. Variable is cost of goods sold and this. Oh wait, no, we already did cost of goods sold, I think. So we have this, these three. Nothing in here. And that's already working fine. Total operating expenses. Let's lower the startup cost a bit. Maybe a reserve of like 25,000. Alrighty. EBITDA, interest, depreciation. Now, how is this depreciation schedule working? I don't think I've updated it yet. I have not. Right. Okay. So we have to separate this out. 5 expansions are going to be 1, 2, 3, 4, 5. So then under this is regular stuff. Above it, these numbers will all be defined already. And this is based on deployment schedule here, expansion 1 through 5. Total cost basis for that would be right there. And these are depreciable, and we need to calculate that to figure out what it might impact taxes, as well as it's used to calculate operating profit. Useful life, the month is this. I believe that's all we need from there. So you got your useful life. This is going to be the depreciation amount per month. And then these are just other items you can put in if you have any other things that need to be depreciated that are not directly related to the expansions. Like if you have a vehicle, company vehicle, or stuff like that. Building, I mean, this is probably going to be just nothing. You're probably not going to have it. I mean, you might have an office. You probably are renting it, but if not, if you are renting it, you just put that as part of one of these monthly costs. If you're actually going to buy a building for your office, I mean, you might if you're scaling. If this is a big operation, where am I? CapEx. Let's say maybe I don't know, a small building, and maybe okay. And the gain or loss on the sale is going to be based on the terminal value. How much of that is percentage is defined for extraordinary income versus applied to CapEx. Alrighty. And that's going to go against the book value remaining based on what depreciation has happened. So this is fine. So this all works dynamically on the income statement. So that's good. What else? So these should be this should be accurate. What's taxable income in year 1? We've got $1 million. Okay, that's fine. And then the exit. We'll deal with the exit value when we get over to the cash flow statement. All right, income statement. Monthly looks good. Let's update the annual. Make sure it's all working. So that's fine. That's fine. We don't need this. Good. And make sure this matches the monthly income statement, which it does. So we've calculated everything the same. Okay. Looking at this calculation. So here we do take extraordinary sale. And then this is based on whatever that is plus this value on this month. Okay. Now make sure we've got this working good. If I change the month, we still matching. Yep, and 2495. Okay, good. Now we can go to the cash flow statement. Customer receipts is revenue. This is going to be, I'll have to update this for sure. So here for other operating expenses, I want this, 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 and this. Okay, looks like we were capturing that. I just wanted to make sure. Okay, good. Interest is fine. Taxes are fine. Net operating activity cash flow. Then we've got CapEx. Looks good. Sale of the business. So terminal value D9. First of all, this is probably going to be valued at its trailing 12 months. Well, trailing 12 month EBITDA is very likely a better metric than revenue. So for this type of business, it's going to be measured on its operational cash flow. So this is an EBITDA multiple. We're just saying 1x. It's probably 3 years, something more than 1x. And then we go cash flow or terminal value. 12 months EBITDA. So for this one, we need to calculate, instead of row 10 on the income statement, we need row 28. So we put that in, and now we have 3x would be 5 million. Alrighty. Now, hold on, why is this 15? Oh, shoot, 5 million times 3. So terminal value of 15. We're doing 5 million in EBITDA almost here. Okay. What's our cash flow look like per month? Oh, it's still positive even with the taxes here. Okay, yeah, this looks fine. Then, so now we have bar and long-term debt. This is fine. And sale of company stock. So here's where we now have to go to the monthly and add these other items for cash flow. And we're going to do this here. So 1, 2, 3, 4, 5. So let's add stuff that's not currently in here. We have, so these are expansion costs, but we need to add in, you know what? We're gonna just do, what's the easiest way here? Other CapEx, and also make all these left justified. So other CapEx would be negative sum of, oh wait, I don't have it. I actually have to go, shoot, there's no easy way to do this. So we're gonna add back expansion costs, and then other, and then total CapEx, which is going to include, so we add this back, and then we go, this is going to be the total of this CapEx here. Because total CapEx, there's other stuff happening, but then this is the expansions based on our dates here. So these are the only expansion costs, then everything else is CapEx. So I'm adding that back, adding each of these back, and then subtracting out the whole CapEx to get the right cash flow. So 150,000. Make sure that's right. Yep, okay. So add that back, then subtract out the total. We also have exit proceeds, if applicable. It's just this cash flow item plus this one. And then we have, obviously, taxes are not in here, so we gotta add that. And then everything else is in here. Now what we do is take this, we want to add back that, adjust that, plus this, plus this. Oh wait, what happened here? Oh, let's just drag this over. Now, the question is, what happened to my cash flow in month 1 or period 0? Ah, I believe, though, the startup costs just went down, so the financing is actually greater than that. However, when we start our CapEx stuff here, all of this, we see how much we actually need. Now this is the important metric, and this is where everything's going to have to balance out. We take the minimum cash position, which is an 87, not 252. So 165,000 is the minimum equity needed to cover those startup costs and operations deployment. What's nice about deploying things further in the future is you have some operational cash flow that, so you don't need to gather money to do that. You can use earned revenues to do it. There's no longer revenue sensitivity, so we don't need that. Let's add all of this to 81. And this is going to be a sum if situation. Now what are we out? These total capex. What's different? 7.5, and here we're at 19 million. All right, let's look at year one, see what we're missing. So that's 441. That's 441, 2629, year two. Yep, year three. 16207. Okay, looks like. Oh, did I not drag this over? There we go. Sometimes sanity checks are your only resource when you've got models that are getting, more on the complex side and have a lot of different tabs going on. You just gotta set up sanity checks to give yourself a chance to catch any potential reference errors. So that's what we're doing here. So we're good on this. We now have balance here. Let's look at the cap table for equity funding. Oh, these are all basically can be much lower. Okay, that's fine. This makes sense. Oh, I want to look at monthly cash flow. Yeah, this is fine. Okay, looking good. Oh, what I wanted to do, so these average sales per day per kiosk, we're going to put this into the deployment schedule as a chart so you can really see what's happening. So check it out. We can do average sales per day per kiosk. Also, we can show total units sold per month or per day. And let's make that a combo. And secondary axis. So this is total sales per day, total units sold per day, and this is total units per day per kiosk. Units sold per day by kiosk and in total. So if you look at this, we can see, what if we had more growth? Now, oh wait, what's going on down here? Now that's a really cool chart. I'm very likely going to be done with this template today, so this is awesome. What is this going? Every 2 months? Can we go every 1 month? Yeah, that's fine. Maybe extend it out a little bit more. So you can see, oh, we need a legend. That's what I'm missing. Average sales per day per kiosk is this. So a given kiosk is starting at, the starting number is 16 in February. I wonder if it's better to show dots. Yes, it is definitely better. Okay, so you can see here we start at 16 average sales per day per kiosk, and we're moving up. And that's going to be based on expansion units added, what they start at, what their starting capacity is, how it increases over time. And I'm wondering, and then this is the amount. Let's see, let's adjust this label. This is total units sold per day, I believe, right? Yeah, that's per day, and then that's per day per kiosk on average. The question is, you've got some kiosks that are going to be doing more, and some are doing less. And I'm wondering if we can granulate that down any a bit. You know what I'm saying? Like, do we want to do expansion 1? There were 10 kiosks. How much are they selling per day over time? Expansion 2, what are they doing? Because all these percentages, this is the average overall, but I think we need it by expansion type to really make sense of what's happening. Let's go to the matrix here. So we got expansion 1. They're selling these. We can add all 3 types together to get total units sold per kiosk. So if we do this, let's see, type 1 sales, type 2 sales, type 3 sales, and we do this here plus here plus here. Or wait, total sales. Expansion 1. And then this be expansion 2, 3, 4, and 5. Because you really want to see what you're saying when you put these numbers in here. What is this actually saying? And we can't really, this is just average aggregate. If we go back down to 1, let's say lower these all to 50%. If we zero this all out, we should flatline. Okay. So there's your increase, and then you flatline because we're actually not going past this. So you get to it, and then the total units sold per day is changing. because as these come on, the unit mix gets different, or the total units like of each type is a little bit different. So the amount sold per day can change. Now, if I were to go 3, okay, it's taking a little bit more time to get there, but we do get there. That's what I wanted to see. So we kind of go up, 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 and then level off. Now that's an average. So let's say on average, you're going to be doing about 80 sales a day per kiosk and 4,800 units per day in total across all kiosks. However, what's expansion 1 specifically doing? And 2 and 3. So if we do total units sold expansion, and then we go total units sold per day by expansion. We take this total divided by days in a month. And I believe that's our number. Let's check it out though. So this is, oh no, 16. I'm at 160 total sold per day. So this is total sold per day. And then we have to divide this one more time by the total unit count. There we go. And to run your analysis, we could do the date up here. What? Hold on, what the heck? $79, $80, $82. Why the heck did this jump from 83 to 85? I do not know. Hold on, this has got to come down one. Okay. So this divided by the 28 divided by the count. And then we can put the date up here. There we go. And this chart now shows, watch this. So we got cut here. Same idea. However, we're showing across each of the 5 expansions, so you can see how those curves up are how this percentage is happening. Now, if we raise these back up to like 80%, now watch, I'll see why this is why I did this. Let's change these chart types to dotted line. Unit sales per day per expansion cohort. Unit sales per day per kiosk for each expansion cohort. Let's get our nice chart formatting in here. Which one was this? This one here. Okay, so now let's make this a little bit higher. We'll go 90 and make these only like 2. Okay, so here we actually never get to the max. Let's go down to 70. All right, so here's what the point was. So you can see with the total, we don't really see where the level off is. On here, I can see where I'm leveling off at, which is around, just under 120 sales per day per kiosk is my maximum. Now, question is, does that make sense? Because we're saying the maximum, absolute maximum is 25 per day, 28 working days per month. But here I'm getting a max of 112. Let's go back to this matrix calculation here. So this is total units sold for each cohort, type 1, 2, and 3. Not the expansion cohort, but the type. And that's calculated by the percentage of capacity attained times K4, E4, and D11, which is this, the count, and the days. So it's saying 10 could get 25, and only 10% of that, so it's 25. And if you divide that by 10, you're actually getting 2.5 per kiosk. Now, what am I missing here? Units sold per day. Got to multiply by the number of days. So 70. 700 and then 70. Now, where am I seeing that? So here's a 700. That makes sense. However, this is 16. Is it because I'm taking type 1, 2, and 3? Yes, that makes sense. Okay, that makes sense because here, total sales of expansion 1 includes sales of type 1, 2, and 3. So really the max per day in theory here is 160. Now we're getting to 70% of that max. We're saying that's the max of 112. So what is 160 times 70? 112. Perfect. Okay, we're making sense. This is what I wanted. All right, so we're starting out 16 total unit sales. That includes all of these. So type out between type 1, 2, and 3, we're selling 16 sales a day per kiosk, and we've got 10 kiosks. This is showing 16 as well because we've only added 1, but look what happens now. 17.3, 20.5. So that's taking the average of expansion 1 and 2. This, however, this top chart is showing each expansion and how it's it starts out here and then how it grows based on this percentage per month and then when it tops off, if it gets to the top off. So this is a aggregation of all of these. Is this. So I think both these are good. Let's adjust, let's see, I want dotted lines. Perfect. Okay, good. Good, good, good. So this will give you a reasonable, it kind of shows you what you're selling per day per kiosk based on these percentages. You can see what actually makes sense, what you think you can really do. And so that'll display here. And then here's the aggregate across all expansions. And we added the total per day across everything. So total per day and then total per day per kiosk. I could do total per day for the expansion as well. So we could put in, so see here we did this. I could do, what would this be? 4,800 total sales in the month. 1, 2, 3, 4, 5, 6. So I can show, watch what I can do here. We can do this. Total units sold by expansion per day. This is per month. And expansion 1, 2, 3, 4, 5. And so this number is simply taking this divided by the days in the month. So 160. And 160 we also see, where do we see 160 at? Somewhere else, because I saw that. 160 here. Total units sold per day. This is total units sold per day by each expansion. So expansion 1 is doing, so those 10 are doing whatever, and then dividing this by the count gives you this number. But we can show this. So now let's look at, yeah. So this is unit sales per day. But not per kiosk. We'll do the aggregate at the bottom. So here, so now this unit sales per day for each expansion is, let me format this number real quick. This is now what this orange thing is here. I think that's orange. I'm half colorblind. That, so you see this is 6,300 is a combination of all of these, 27, 16, 1,000, 483, 84. So this is saying how many of your cohort 1 of 10 kiosks, what are they doing per day? All 10 together, and etc. And that will change based on all these assumptions as well. And then here's the unit sold. This is probably the most important one because you can really see, okay, per day, how much can I realistically sell? This is per day for the total. So this is just multiplying this number by the total count of kiosks. And then here you're getting the aggregate of both of these in one line each. Now we could also probably do, let's think about this. We could show other expansion metrics. I had one more idea. I can't remember it. Let's see, unit sales per day. I don't know. I think that was it actually. So this is good. Very good. And it's really good when you can adjust the assumptions here and see what it actually means over here. Realistically, that I think makes a lot of sense. All right, so we got a whole bunch done today. The income statement's done, cash flow statement, executive summary, distributions we got to do real quick, monthly and annual details fully updated. We just ended on the cash flow, and then I got kind of caught up in that visualizations for the deployment schedule, but I think this is awesome here. So let's see, balance sheet, let's just make sure. It looks like it's fine. It's all balanced. So you got cash. We're solving for zero cash. So that makes sense. Let's look at the annual. That's fine. We'll do our sanity checks. Well, I guess I could do this here now. So let's put our years up, and then I'm summing up. What's my cash flow? 86. I really, really like how this model has turned out. We did so many upgrades, and it's fun to do upgrades on the old stuff because there's just so many different things that can be added to make it better. And we've done that here. So what's the detail? Year is in 1. So there's positive cash flow items. I'm going to do the same thing for negative. We'll do our discounted cash flow analysis right here. We've got remaining equity to use. So this would be total requirement 185 minus startup costs and then plus debt raised or financing from bank. So 330. The actual contributions were this number 185. All right, so the IR of the project obviously very high here. And again, my numbers are arbitrary. If I were to say, what if you're only doing 10 sales a day, 15 and 70, that's a lot. This would be a different number. Yeah, still high. I say my running costs were like 1,000, 1,500 a month per person, and I needed, a person can only do about 3 a month. Say these are just random, but 15,000 a month. Again, you can go in, and this is what's nice about this is you can go in and do your research and figure out all these assumptions that make sense for your situation. It's very granular, very bottom up. All right, 418% IRR is where we're going to sit. So this is discounted cash flow based on this discount rate. We've got the investors and owner side, which is based on cap table inputs here. This looks good. Okay. Let's do, so cap table itself needs updated as well. You see how some of these charts changed. Trailing 12 month EBITDA is still 5 million. Wait a second, did that even change? Hold on. 5.1. Yeah, I guess that's not a huge impact. We'd have to change. Let's say the biggest impact is probably, let's change our margins. Let's say percentage of total revenue here on these is like 25 and 15, and then maybe 10. So you're making 50% on your ingredient costs. That'll probably be the biggest effect here. Yeah, now you're down to actually a reasonable internal rate of returns that don't look insane. Now you could have insane internal rate of returns though if the business does really well and it didn't take that much to get off the ground and you scaled nice. It's possible they could be off the charts. So just know my numbers are arbitrary. Okay. So now you're seeing margins around 50%, 0.6, and then what did we say let's say our multiple here is 2. There's your break even on equity. Let's make this 5. Okay, nice. So there's a break even. That's before the exit. Now, we have, so terminal value cap table, all this is good. To finish up, I need to do sanity checks. So annual net income versus monthly. We've done that here. Just make sure that equals 0. Balance sheet monthly is, and annual is 60 and 60. Let's make sure that's right. Yep. Yep. Let's check annual detail against monthly. So that's making sure the annual, these two are the same. Annual detail check. So here, income statement, balance sheet. So we're checking the cash flow balance of the balance sheet against the cash flow balance on the annual detail. And that will always be different by the equity raised. Then we have executive summary, cash. What do we got going on here? Let's look at the executive summary. What is this 3-year? Oh, this is IRR. What are we saying here on the annual that it's not? I could do a monthly instead and convert it because usually it's a 5-year. I did a 3-year and I've got some, so we can just do this. So that's the monthly. We need to actually convert that though, which I believe, what's the calc here? I've got it on one of these waterfalls. Let me check. I think it's on the joint venture one. Maybe the real estate one. So going from a monthly IRR to annual. Here it is. So 1 plus the rate raised to 12 minus 1. So it's 1 plus this rate raised to 12 minus 1. So 200%. And so 9.6. Let me double check that. So if I put 9.6 into here. Yep, okay. Don't save. So there's the IRR. 200% on the whole project, which should be similar. This is 131, but it's different going from an annual compared to doing it monthly. It's more accurate on the monthly. But that's fine. Months active. Oh, let's put this to 3 full years. Any cash position. So required 700,000, made 8 million. Okay. Good, good, good. Oh, right. So we're doing the sanity checks. Annual detail check against monthly. So I did that one. Executive summary. Oh, right. Executive summary doesn't, well, we could try to balance it though. We could say the sum of all of this, all of the cash flow, because it doesn't have everything. We added a whole bunch more stuff. Can I insert here without messing up these charts? No, I can't. So this is like, shoot. I don't want to have to move this around. I guess the executive summary can just have these items. Cash flow before tax and other CapEx. So it's going to have all of the deployment costs, but it's not going to have any random CapEx you have like here or here. And it doesn't have tax. What else would we be missing? This. Oh, exit proceeds. Do we have exit proceeds in here? No. And so this is everything before exit. I guess that's fine. We just won't have a sanity check for this one. Distributions to annual ending cash flow. So this should equal this. And it does. Distributions B9 to G9. Let me double check. Yep, okay. And then finally, individual distributions, cap table. That's just checking this bottom part here, which looks good. And then 70.5, 386, 70.5. So that's the same. That's good. All right. Let's start adjusting some of these variables and making sure everything still works. So I'm going to say, what if we don't include terminal value? I should always see zeros down here in all these sanity checks as I change the dates. Good. Put this to yes. Perfect. Let's go to only like a 2-year. Looks good. And then what if I do partial within that? Good. Good. Okay, so we're all zeros there. That's great. These are always what cause issues, is the timing. But I've got all the formulas I imported yesterday when you were watching that is really nice because it's set up to work with all this, so it's nice. All right, all I have to do now, I'll update the index tab to include all the new stuff, and I'll do an overview video of it, and I'll post it, and this automated kiosk template will be completely upgraded. We've added all new logic for deployment and revenue, new and better logic for operating expenses and variable costs, startup cost, CapEx, this is all new, cap table, this is all new, terminal values new, and then obviously the income statement or the financial statements for monthly, annual, and a 3-year max. Executive summaries looking good. All these visuals still look good. All right. This is great. Good stuff. So I didn't think I'd finish it in 2 days, but because there was so much other stuff to do with this thing, with all the revenue logic and things breaking and all that, but almost a 2-hour stream, which is longer than I normally do. I only go about an hour usually, but I'm feeling good, so we're just plowing through. All right, tomorrow I'll do the overview video, and then maybe if you guys have suggestions, I'm open to building some kind of financial calculator, like a 1 or 2 tabber. If there's any good ideas, I might build something or upgrade something in the past. I do a lot of other stuff besides just startup models. There's stuff for accounting, like volume discount pricing, accounting ratios, cash conversion cycle, inventory stuff, HR tools, employee data tracking, HR tool hiring and firing planner, Gantt schedules for planning crews, employee scheduling, KPI dashboards, all sorts of things here that are, on top of doing just startup models. I've got a lot of tools, cash flow tools, joint venture stuff. All right. Well, don't forget, check out, again, you can buy all templates in bulk here by category, browse, or you can buy them individually. If you want to essentially get everything I've ever done, you can go $9.99 here, great value. And I will see you guys on the overview video tomorrow, and then we'll start. So next week, let's see, where are we at on the list here? We just did this. So next week will be the food truck. I think that's going to have a lot of updates. That's the older one. Yeah. Whoa. Oh, it's annual only. So I'll have to go to another annual only. I think the mining model will fit this good. Hopefully. Might do some. Yeah, it's going to take some work. So that'll be next week. And then after that, we've got what? General rental. That's a good one. This is an updated. Yeah, this is a good one to do. This will be good. General rental. Then we have next starter model cleaning services, janitorial, and then we've got enterprise SaaS. That's going to be a great one to do. I actually can't wait for that. And lending business already has it, and then we'll be out of our top 50, but we'll still be updating until we get through them all. Alrighty, check